Welcome back to watching All About Stocks on ET Now. Ketan Karkhanis of ICICI Securities is still with us in the studio and he's helping us find stocks we should be investing in this market. Now, Ketan's first recommendation this week is a growth stock. He's recommended Asian Paints. Now, all of us are familiar with the brand, but if you haven't been tracking the stock of late, my colleague Darshan has put together a quick introduction on the performance of this stock in the last couple of years. Take a look.
India's largest paint company, Asian Paints, controls half of a country's paint market. But is that good enough to make the stock a good investment for you? In India, the company manufactures a range of decorative paints, varnishes and enamels. Asian Paints has given its investor a return of 22% over the last year. But that is lower than its peers, Berger Paints and AkzoNobel. While domestic decorative paint segments continued to post healthy growth this quarter, the auto and the industrial paint segment saw a weak performance. Let's look at Q1 numbers. Sales were up 23% year-on-year, while net profit was up 18% from the same quarter last year. The company's profit has been on the rise over the last 4 years, although the increase has not been as sharp as it was witnessed in FY10. Since the sale of paint depends a lot on the sale of new cars and new homes, the company has said that it is rather cautious on growth because rising interest rate is something that is putting a lot of pressure on domestic demand. Remember, rising raw material costs put a lot of pressure as far as pricing is concerned. And the company has already raised its price by 8% in the last 3 months. 15 of the 26 brokerage firms we spoke to recommended buying the stock right now, with the most bullish target price coming from Nomura at 3650.
Thanks, Darshan. Now, that was Asian Paints. Ketan, how does it make the cut really? This is a business that is dependent on crude. It's also dependent on real estate reviving, on auto reviving, because you need to paint your homes, you need to paint your cars. So, what makes you think that this stock is going to do well? Why does it make your recommendation list?
If you look at the last 10 years, Asian Paints, the market capitalization of Asian Paints has grown 14 times. And at the same time, it has clocked a dividend yield of around 2.4%. If you look at the top line growth, it has increased its revenue by 5 times. That is a CAGR growth of around 20% on the top line and 26% on the bottom line. Going forward, we expect that the demand from the repainting segment, especially from the tier 2 and the tier 3 cities, is likely to be robust.
Ketan, also we know that this company has been increasing its prices over the last couple of months, which means that its pricing is under pressure right now because the raw materials have become more expensive. Do you think the company is in a position to handle these kind of pressure? Can they keep increasing their prices and still manage business?
See, if you look at the last 10 years, Asian Paints has increased its margin from 16.2% to 18.1%. In the last quarter, we have seen some amount of pressure on the margins. But we expect that Asian Paints, being the leader in this segment, will be able to pass on the cost of high raw materials to its end customers. I think that is the reason we still feel that it will continue enjoying its premium valuation that it is currently having. And it is likely to continue growing at 20% plus CAGR. So I think that is the reason we would still want to recommend Asian Paints.
It's all-time high, nearly its all-time high right now. High valuations. Isn't it an expensive stock for a retail investor to buy?
See, looking at the track record of Asian Paints, it is a classic growth story that we have been seeing, and it has consistently delivered over its expectation that the market has placed on it. And that is the reason it will continue to have that premium valuation. In spite of the depressed market condition, we have seen the stock being trading at its near life highs of 30 to 50. Going forward, we have a 12 months target of around 3,400 on the stock, which still provides upside of under 10 to 12% from the current market rate. But if the investors choose to hold on to this stock with a 3 to 5 years perspective, the stock has the potential of returning around 25% CAGR growth year on year.
That first pick that Ketan gave us was Asian Paints. Remember, he did say that it is at its all-time high nearly, but if you're looking at a 2 to 3 year horizon, then it makes sense. He's expecting it to give you 25% CAGR, which is a compounded annual growth rate and a return on that stock. Okay, so next recommendation is a value stock. He has recommended Jet Airways. Now again, we are familiar with the brand. We've all heard of Jet Airways, but has that stock really been performing? What has that stock been up to? Well, Darshan is back again and he's put together an introduction on Jet Airways. Darshan.
India's first listed airline, Jet Airways, flies to 24 international destinations and operates flights to and from 51 destinations in India. Its stock has given investors a loss of 32% over the last year, on par with its peers. The company has been raking in losses for the past 4 years, but the damage has been on a steady decrease. The cost of fuel, which accounts for 2/3 of the operating cost of an airline, still remains a large concern for Jet. If you remember, in 2007 what had happened was that Jet Airways had taken over Air Sahara, the flights now which it runs as Jet Life. Now since then what has happened is that Air Sahara has taken Jet Airways to court, claiming that the liabilities that it has on the book will now have to be borne by Jet Airways. Analysts feel that this court case will be the big catalyst that is needed for the Jet Airways stock. The carrier is in process of commercially exploiting the land it owns in the Bandra Kurla complex in Mumbai, and it hopes to use the money to repay debt. Stiff competition in the sector and pressure on pricing keeps the outlook for the September quarter low.
Alright, now before I go to Ketan, I want to pull this up. This is Jet Airways in comparison to the Sensex, and you see it hasn't done too well at all. Ketan, the numbers are not on the side of this stock. It hasn't been giving its investors profit. In fact, the entire aviation industry hasn't been giving its investors profit. It's dependent on crude right now. So, are you suggesting we take a bet on crude as retail investors? Do you see a light at the end of this tunnel that suggests this stock is going to make profit?
If you look at the operating margins in the last FY11, it has clocked an operating margin of 10.8% against its peer, which is around 2 to 3%. This it has achieved because of high operational efficiencies and the prudent mix of flights across international and domestic destinations. As you all know, crude prices have really impacted the airline stocks. What we expect, if the crude at first stays stable here, the company is likely to turn into black this year in FY12. And looking at the healthy traffic growth that we see in the passenger traffic in the next 3 years, the stock is likely to grow at 20% CAGR on the revenue front. If the crude prices correct from here, that is immediately going to impact the bottom lines, because the stock has been through the crude price hikes, and we believe that it is bottomed out at this current levels.
And if crude continues to go up further?
See, that is a risk that we may have to take when we get into this stock. But if the crude corrects slightly also from here, or it remains stable also, that will definitely impact the bottom lines immediately of the stock.
But my question is, as a retail investor, I don't have all the money in the world. I just have my life savings. I'm going to carefully pick 1 or 2 stocks for my portfolio, a maximum of maybe 5 or 6 stocks in my portfolio. Why do I need to have aviation in my portfolio? Can't I just do without it? It's a sector that's not making any money. Policy is against it right now. It pays a lot of tax. Fuel is against it right now. Why can't I just skip past the aviation sector? What makes you think I need to have aviation in my portfolio?
As you rightly pointed out, all of these factors that you pointed out have already been priced into the stock. And since we are talking about a value stock, the value stocks have to be bought when the cycle is against it, when the stock is at its bottom.
But I want to understand from you, if I'm taking a risk on the crude price, if I'm taking a risk on an aviation sector, what sort of returns can I expect from a stock like this? What sort of returns do you expect it to give with the risks that we're taking?
See, the returns obviously will be higher commensurate to the risks that you're taking in this. We expect a 30% CAGR growth in this. If you look at a 3 years horizon, this is one stock which should definitely pay off. And also it is a proxy on India's consumption play. So I think this is a stock worth taking the risk.
Alright, Ketan telling us there that Jet Airways, he thinks, is a stock worth taking a risk on. Remember, he says 30% compounded annual growth rate is what he expects from Jet Airways. But remember, this is a stock that has a certain amount of dependency on crude, a lot of dependency on the price of crude. So actually taking a bet on whether the price of crude will stay stable or come down, and that's possibly one of the situations when the stock will actually improve. Or if you think the price of crude is going to go up further, then that might not be a risk that you want to take. That's something you need to consider. So if I take up on what we talked about in this segment, Asian Paints and Jet Airways, Ketan telling us that these are 2 stocks we need to have in our portfolio. We're going to slip into another break. On the other side, we're answering the questions that came in from you during the week. So don't turn away.